Index funds, mutual funds, hedge funds, and ETFs are super useful tools for building wealth over time. Have you heard these terms before? If not, let me explain them one by one. Before we start, let's first understand what funds are. A fund is basically a pot of money set aside for a clear goal, and it's managed so the money doesn't get wasted. Instead of cash being spent randomly, a fund gives it direction. Governments use funds for roads and schools, companies use funds to grow their business, and individuals use funds to plan for the future. The whole idea is simple: money with a mission. For example, take Luke, a regular guy in the US. Luke decides to start a family future fund. Every month, he puts part of his paycheck into that fund instead of spending it all. Over time, that money is used to invest in stocks and savings accounts, helping him pay for his daughter's college and build long-term security. That's a fund in action. Luke's money working with purpose, not just sitting or disappearing on everyday expenses. Picture this: you and a bunch of your friends decide to throw an epic road trip. Instead of one person footing the bill for gas, snacks, hotels, and tunes, everyone chips in a little cash. That pooled money covers the whole adventure, and everybody enjoys the ride without stressing about the logistics alone. That's basically how an investment fund works. A group of investors pools their money together, and that collective pot gets invested in a mix of assets, like stocks, bonds, real estate, you name it. You don't have to pick every single investment yourself. The fund manages it, and you share in the wins or losses proportionally. Simple, right? It spreads the effort and the risk. All right, let's start with index funds, because these are the ones you hear about everywhere these days. Influencers are always saying, just dump your cash into an index fund and chill. And honestly, there's a ton of truth to that for regular folks like Luke. An index fund doesn't try to outsmart the market by picking hot stocks. Nope, it just mirrors a specific market index, which is basically a ready-made list or benchmark of companies that represents a slice of the market. Take the S&P 500, for example. It's a lineup of 500 of the biggest, most solid US companies. Think Apple, Microsoft, Amazon, and so on. The bigger the company, the more influence it has on the index's performance. When the S&P 500 climbs, it usually signals the overall US market is doing well. There are tons of other indexes too. You've got the NASDAQ for tech-heavy names, the Dow Jones Industrial Average, tracking 30 blue-chip giants like Coca-Cola or Boeing, small-cap indexes for up-and-coming companies, international ones for global exposure, emerging markets, or even sector-specific ones like healthcare or clean energy. You get the picture. No guessing games, no crystal ball required. These funds are passively managed, meaning there's no star manager actively trading every day. They just track the index automatically, which keeps costs crazy low. We're talking expense ratios typically from about 0.03% to 0.15% these days. So if you invest $10,000, you might pay only $3 to $15 a year in fees. That's peanuts. Big players like Vanguard, BlackRock, with their iShares line, and Fidelity, run some of the best ones. Because your money is spread across hundreds or thousands of companies, index funds offer solid diversification, which lowers risk compared to betting on single stocks. If one company tanks, it barely dents the overall fund. They're not zero risk, of course. Markets go down sometimes, but they're generally steadier for the long haul. One key thing to know: traditional index funds, the mutual fund version, only price once a day, after the market closes. That price is the net asset value, NAV, calculated from all the fund's holdings minus expenses divided by shares. If you place an order mid-morning, it processes at the end of day NAV. No real-time trading like stocks. For long-term investors like Luke, who isn't day trading, that's no big deal. It's actually simpler and less stressful. Why are index funds so popular? Low fees, minimal effort, and historically strong long-term performance. Even legends like Warren Buffett swear by them for most people, because beating the market consistently is really tough. Now, let's shift to mutual funds. They look similar at first, pooling money, diversifying across assets, but the big difference is management style. Most mutual funds are actively managed. That means a pro fund manager or team is constantly researching, buying, and selling to try to beat a benchmark like the S&P 500. Sounds appealing, right? In theory, yeah, but in practice, higher fees come with it. Expense ratios often run from around 0.50% to 1.0% or more. Studies show most active funds don't beat the market over time after those costs. Still, some folks like them for targeted exposure to specific industries, regions, or strategies that index funds might not cover as well. Providers like Vanguard, Fidelity, and JP Morgan offer both active and passive versions, so always check. Like index mutual funds, trades happen at end-of-day NAV, no intraday flexibility. Next up, hedge funds. These are in a whole different league, way more aggressive and exclusive. The hedge part originally meant protecting against downside risk, but today they're mostly about chasing big returns with sophisticated and risky tactics. Hedge funds pool money from wealthy individuals or institutions, usually accredited investors with high income or net worth, because the risks are serious. They invest in stocks, bonds, currencies, derivatives, real estate, you name it, and they use tools like short selling, betting against assets, leverage, borrowing to amplify bets, and complex derivatives. They're actively managed with lots of freedom for bold moves, which can lead to massive gains or massive losses. Fees are steep. The classic 2 in 20 model, though it's evolving, with many now below 2% management plus 20% of profits, means 2% of assets yearly plus 20% of gains. That's expensive, so they need to deliver outsized returns to justify it. Volatility is high, and they're not for everyday investors like Luke or most of us. Finally, ETFs, exchange-traded funds. Think of them as the cool hybrid. They combine the diversification of index funds with the trading flexibility of individual stocks. Most ETFs are passively managed, tracking an index just like index funds. You can buy or sell them all day long on the stock exchange at real-time prices. Super convenient if you want to time entries or exits. Fees are low, often 0.03% to 0.20% or so, sometimes even lower than mutual funds. Many trade commission-free on brokerage apps too. You can get an ETF that mirrors the S&P 500, tech, bonds, international markets, pretty much anything. They're accessible, low cost, and great for building a diversified portfolio quickly. Wrapping this up, for most everyday investors, like Luke the driver or you and me, index funds or ETFs are usually the smartest pick. They're cheap, simple, diversified, and built for long-term growth without the hassle. Mutual funds can work if you're drawn to a specific active strategy or niche exposure, but watch those higher fees and the odds of underperforming. Hedge funds? They're for high net worth folks comfortable with big risks and big fees in pursuit of potentially bigger rewards, not the average person. There you have it. Everything you need to know without the fluff. Hope this clears things up and saves you years of figuring it out the hard way. If it helped, drop a like, subscribe for more practical finance breakdowns,